In this presentation, we're going to take a look at itemized deductions related to casualty and theft losses. We're going to be concentrating down here in our income tax equation, down in the itemized deductions. Remember, the first half of the income tax equation is basically an income statement, starting with revenue or income minus the above the line or Schedule 1 or adjustments to income deductions. That gives us the adjusted gross income or AGI as subtotal. Then we take the greater of the standard deduction or itemized deduction. We're focusing here on the itemized deductions or a component of them, which we would only be considering if we think that those itemized deductions will be greater than the standard deduction. We're focusing down here on page 1 of the 1040. That's going to be on line 9, which is the standard deduction or itemized deduction. We here concentrating on the itemized deduction. We're going to be looking at the Schedule A. Schedule A focusing in on the component of casualty and theft losses within the Schedule A, which is this little part of the form here on the Schedule A. For more information, you could start your research if you have more questions on it at the instructions for Schedule A, which we will include, and they can be found on the IRS website at IRS.gov. You can also take a look at instructions for Form 4684, which can be found on the IRS website as well. Casualty and theft losses. Personal casualty and theft losses of an individual sustained in a tax year beginning after 2017 are deductible only to the extent they're attributable to a federally declared disaster. So that's a fairly new change, 2017. The loss deduction is subject to $100 per casualty and 10% of your adjusted gross income AGI limitations. And exceptions to the rule above limiting the personal casualty and theft loss deduction to losses attributable to a federally declared disaster applies if you have personal casualty gains for the tax year. So then, in other words, if you had personal casualty gains that would possibly net out against the casualty losses. In this case, you will reduce your personal casualty gains by any casualty losses not attributable to a federally declared disaster. In other words, if you had gains resulting in some kind of casualty, then the question would be, well, do I have to include the gains on the tax return? Because you'll recall that everything has to be included in income unless stated otherwise. Typically, that's kind of the general rule in terms of income. We don't want to include it in income because it was casualty related, basically income. So you're going to net that out, the income from the loss, which would generally result in that case if you had casualty income and the loss and netting it out, not having to record the income and not recording the expense, because the two would net out. It would have no effect on the bottom line of taxable income, no effect therefore on income. Any excess gain is used to reduce losses from a federally declared disaster. The 10% AGI limitation is applied to any remaining losses attributable to a federally declared disaster. Definitions. Federal casualty loss. A federal casualty loss is an individual's casualty or theft loss of personal use property that is attributable to a federally declared disaster. The casualty loss must occur in a state receiving a federal disaster declaration. If you suffered a federal casualty loss, you are eligible to claim a casualty loss deduction. If you suffered a casualty loss or theft loss of personal use property that was not attributable to a federally declared disaster, it is not a federal casualty loss, and you may not claim a casualty loss deduction unless the exception applies. See the caption under losses. You can deduct later. Disaster loss. A disaster loss is a loss that is attributable to a federally declared disaster and that occurred in an area eligible for assistance pursuant to the presidential declaration. The disaster loss must occur in a county eligible for public or individual assistance, or both. Disaster losses are not limited to individual personal use property and may be claimed for individual business or income producing property and by the corporations, S corporations, and partnerships. If you suffered a disaster loss, you are eligible to claim a casualty loss deduction and to elect to claim the loss in the preceding tax year. See disaster loss later. Qualified disaster loss. A qualified disaster loss is an individual's casualty or theft loss of personal use property that is attributable to a major disaster declared by the President under Section 401 of the Stafford Act in 2016, as well as from Hurricane Harvey, Tropical Storm Harvey, Hurricane Irma, Hurricane Maria, or the 2017 California wildfires. If you suffered a qualified disaster loss, you are eligible to claim a casualty loss deduction, to elect to claim the loss in the preceding tax year, and to deduct the loss without itemizing other deductions on Schedule A, Form 1040. See Publication 976 for more information here. Losses you can deduct. For tax years 2018 through 2025, if you are an individual, losses of personal use property from fire, storm, shipwreck, or other casualty or theft are deductible only if the loss is attributable to a federally declared disaster, federal casualty loss. You can see Publication 547 for more information there. If the event causing you to suffer a personal casualty loss occurred before January 1st, 2018, but the casualty loss was not sustained until January 1st, 2018 or later, the casualty loss is not deductible. See when to deduct a loss later for more information on when a casualty loss is sustained. If your property is covered by insurance and your loss is otherwise deductible, you should file a timely insurance claim for reimbursement of your loss. If you didn't file a timely insurance claim, you can't deduct the full unrecovered amount as a casualty loss or theft loss, and only the part of the loss that isn't covered by your insurance policy. So obviously the idea there is that if you have a loss and you have an insurance policy, you're going to be recuperated for the loss on the insurance, and you're not going to get to deduct the loss if you got the insurance proceeds to basically cover the loss. Now you can think, well, what if someone basically had a loss and then they didn't file for the insurance until the next year possibly, and therefore they didn't get the recovery of the loss? Can they record the deduction? Well, no, because you didn't timely file the insurance. The idea of the loss would be that you had a loss, you didn't get it recovered by the insurance, and you normally would only be able to deduct the portion of the loss that wasn't recovered in some other way, such as through insurance. Related expenses. The related expenses you have to have due to a casualty or theft, such as expenses for the treatment of personal injuries or for the rental of a car, aren't deductible as casualty or theft losses. Costs for protection against future casualties aren't deductible, but should be capitalized as permanent improvements. So what if you're going to do something to your home in order to safeguard against a future casualty? Well, that's not a casualty loss. The loss didn't happen. However, that might be an improvement to the home that might be included in the value of the home, and therefore could be a benefit when you actually sell the home, or possibly if you're depreciating the home because you're using it for business use or something like that. An example would be the cost of levee to stop flooding. Losses you cannot deduct. Money or property misplaced or lost. So when you think about these losses, oftentimes people will come up, well, yeah, I lost money this year. I misplaced money, or I lost some money or something like that. That's not, something that'll typically be deductible. So losses you cannot deduct: money or property misplaced or lost, breakage of china, glassware, furniture, and similar items under normal conditions. So something under normal conditions basically broke or something like that. That's not going to be something that typically will be deductible. Progressive damage to property, building, clothes, trees, etc., caused by termites, moths, other insects, or disease. You can see Publication 547 for information on treatment for deteriorating concrete foundations. Then we have a decline in market value of stock caused by disclosure of accounting or other illegal misconduct by the officers or directors of the corporation that issued the stock that was acquired on the open market for investment. You may be able to deduct it as a capital loss on Schedule D if the stock is sold or exchanged or becomes completely worthless. So in other words, if you have investments in stocks go up and down all the time, so the loss there would be a capital gain, possibly a capital gain loss, but not a Schedule A loss. Well, what about a situation where someone lies and you have this kind of scandal thing that possibly would happen, and they didn't value their financials right or something like that? Well, still, you would think it might be something on the Schedule D if it was a capital gain or loss, but not something typically on the Schedule A in that situation. when to deduct a loss. So when do we get the deduction, or when should we deduct the loss if it would be applicable? Generally, you can deduct part of your casualty or theft loss that isn't reimbursable in the year the casualty occurred or the theft was discovered. However, a disaster loss and a loss from deposits in insolvent or bankrupt financial institutions may be treated differently. See disaster losses and special treatment for losses on deposits in insolvent or bankrupt financial institutions later. If in the year of casualty there is a claim for reimbursement with a reasonable prospect of recovery, the loss is not sustained until you know with reasonable certainty whether such reimbursements will be received. So in other words, if you're going to get money back in some type of reimbursements from like insurance, then the IRS wants you to net that out before basically you take the loss. If you aren't sure whether part of your casualty or theft loss will be reimbursed, don't deduct that part until the tax year when you become reasonably certain that it won't be reimbursed. This later tax year is when your loss is sustained. If you are reimbursed for a loss you deducted in an earlier year, include the reimbursement in your income in the year you receive it, but only to the extent that the deduction reduced your tax in the earlier year. So in other words, if you're going to get reimbursed, then typically you want to know what the reimbursement is so you can net that out. If for some reason you didn't know what it was, you took a deduction in one year, and then in the following year you got reimbursed for part of the amount that you took the deduction for, well, rather than amend the return that the deduction was taken in, they're saying take the income, record the income in the following year, but only to the extent that you got a benefit from the loss in the prior year that you were then reimbursed for in the current year. Disaster loss. A disaster loss is a loss that occurs in an area determined by the President of the United States to warrant federal disaster assistance and that is attributable to a federal declared disaster. It includes a major disaster or emergency declaration. To determine the amount to be deducted for a disaster loss, you must take into account as reimbursements any benefits you received or which you have a reasonable possibility of receiving from federal or state programs to restore your property. Disaster year. The disaster year is the tax year in which you sustained the loss attributable to a federally declared disaster. Generally, a disaster loss is sustained in the year the disaster occurred. However, a disaster loss also may be sustained in a year after the disaster occurred. For example, if a claim for reimbursement exists for which there is a reasonable prospect of recovery, no part of the loss for which reimbursement may be received is sustained until it can be ascertained with reasonable certainty whether you will be reimbursed. So in other words, they're looking at that reimbursement again. They want to net out the reimbursement. If you don't know when the reimbursement is, they would like to say, hey, you don't get the deduction until that is known, which would typically be the following year, even though the disaster happened in the current year.